Welcome back everyone, Tyler Lavoie here, financial planner. This is the final video in the series, in some ways the most practical one. So we covered how taxes work in retirement and the Roth conversion window. Today we're going to discuss the order in which you draw from your accounts and why it matters more than many people do realize. And so here's a question I don't hear often enough in financial conversations. In what order should I take my money from my retirement accounts? Most people spend decades focused on the accumulation side, how much to save, where to invest, when to increase their contributions. The distribution side gets a fraction of that attention, unfortunately. But the withdrawal sequence is where real money is either kept or unnecessarily handed to the IRS. And the decisions aren't always obvious. So the same $60,000 withdrawal can produce very different tax bills depending on which account it comes from. If you pull $60K from a Roth IRA, essentially no federal income tax. If you pull it from a traditional IRA, that is taxed at ordinary income, potentially at 22% or more. And the ripple effects go further. Drawing too much from the wrong account in 1 year can push Social Security into taxable territory, triggering Medicare premium surcharges or move you into a higher bracket. If you do this thoughtfully, however, withdrawal sequencing doesn't just save taxes in 1 year, it can actually extend the life of your portfolio and reduce your lifetime tax burden. That is why this matters. And so I want to do a quick review of the 3 different types of accounts. So there's the taxable accounts, right? Brokerage and savings. These are taxed on gains and dividends as you go. There's no RMDs for these, but they are subject to long-term capital gains, which get favorable rates, and short-term capital gains, which have different holding periods. Then there's tax-deferred accounts. This is your traditional IRAs, your employer plans. Every dollar you withdraw is taxed as ordinary income, and the RMDs start at 73 for these accounts. The tax-free accounts, the Roth IRAs, the Roth 401ks, these have tax-free growth, tax-free qualified withdrawals, and no RMDs. So the account type determines the tax treatment that you face, and where you draw income each year determines how much of it is overall taxable and at what rate. And so the conventional guidance on withdrawal order is start with taxable accounts, then tax-deferred, then tax-free accounts last. The logic is sound, so this is where you preserve the tax advantage accounts so they can keep growing and delay taxable income as long as possible. This is a reasonable starting point and works well for many people, but there's a more nuanced version that takes into account what happens when you follow this approach rigidly over many years. And so this is where we see the conventional falling short, and it runs into a few challenges over time. First is if you drain taxable accounts too quickly, you actually lose your ability to draw capital gains income at favorable rates later, which can be valuable. Second is if you defer all traditional IRA withdrawals until RMDs force them, you can actually face larger required RMDs in your 70s that actually put you in a higher income brackets at a time when you have less flexibility to adjust. Third is leaving Roth accounts completely untouched for decades may mean missing the opportunity to use them strategically in years when your income is lower. The conventional sequence isn't wrong, it's just not complete, and a more tax-aware approach considers both what you draw and when. And so the tax-aware withdrawal strategy doesn't follow a fixed sequence. So instead, it asks this question: given all my income sources, where am I in my brackets? And what combination of withdrawals minimize taxes this year while best positioning my accounts for the longer run? Is there room to take some tax-deferred income at a lower rate, really without crossing into a higher bracket? Could Roth funds be used to avoid bracket creep? One theme that comes up consistently in tax-aware planning is preserving Roth accounts as long as makes sense. Not as long as possible, as long as makes sense. Roth IRAs have no RMDs, remember, so they can grow indefinitely during your lifetime without forced distributions. When you pass them to heirs, they actually receive the income tax-free. They have to follow a 10-year distribution rule if they're not a spouse. And so in the latter years, when other income sources may be elevated, having tax-free Roth withdrawals available gives you more options. Now, for some people, drawing from Roth strategically in lower income years to fill unused bracket space can be worth it. Individual circumstances can vary though, and so the point is to never touch the Roth. The point is that it's often your most flexible source of income, and flexibility in retirement is extremely valuable to have. And so once RMD distributions begin at 73, part of your annual income calculation is no longer fully in your control. The IRS requires the distributions from every single tax-deferred account, and those minimums are based on your balance and a life expectancy factor that decreases over time. So this is why the years before 73 are so important, like we talked about in the past video. If you can reduce that tax-deferred balance through strategic withdrawals or Roth conversions before RMDs begin, you enter your RMD years with less forced income to manage. And so the goal is to arrive at 73 with a smaller tax-deferred balance, so the IRS has less control over your overall bracket space. And so here's a simplified illustration. And so just to be clear, this is hypothetical, not a recommendation, but imagine a couple at age 67 with $60,000 in spending needs for the year. They have three types of accounts available. One possible approach is $20,000 from the brokerage account, taxed at favorable long-term capital gains rates, $30,000 from the traditional IRA, filling the bracket without crossing into a higher rate, and $10,000 from the Roth IRA, if needed to avoid bracket creep. So this isn't a formula, it's a way of illustrating the type of thinking that goes into tax-aware withdrawal planning. Ideally, to close out the series, tax-smart retirement is really three connected ideas, and these are the takeaways I want you to have. So retirement taxes are different. Understanding them, how brackets, RMDs, and Social Security interact, gives you a foundation. The window before RMDs begin is your most important tax planning period, including the Roth conversion strategy we had covered. And withdrawal sequencing, withdrawing the right amount from the right account each year, is where those decisions play out over time. All three strategies work together. The right plan is specific to your situation, which is why the conversation ultimately matters, because you want to be able and you want to consider all available options before making any serious decisions. And so if you'd like to talk through your withdrawal strategy and what a tax-aware retirement plan might look like for your specific situation, I'd invite you to book a 15 to 30 minute complimentary consultation. My name's Tyler Lavoie. Thanks for watching, and I'll see you in the next video.